China is buying silver, not quietly, not occasionally, but in volumes that are forcing its domestic price to break away from the rest of the world. And when a nation this large starts paying more for a strategic metal, the question is no longer what is the price. The question becomes, what do they know that the market doesn't? Because history shows something uncomfortable. When physical demand disconnects from paper prices, repricing does not arrive gently, it arrives suddenly. And if this is not just industrial demand, if this is preparation, if this is about currency confidence in a fragile global system, then the next move in silver won't feel fair, and by the time it's obvious, it may already be too late. Welcome to Boring Currency Reports. Before we begin, if you've lived long enough to know that markets rarely give second warnings, then take a moment to subscribe, not for noise, but so you don't miss the signals that actually matter. And tell us in the comments, from where in the world are you watching this today? At first glance, the silver market looks familiar. Prices rise, prices fall, opinions clash, and charts circulate across financial media. To many observers, it feels like another volatile commodity cycle. But seasoned analysts understand that the most important market shifts do not begin with headlines. They begin quietly in the structure of demand and supply, long before price confirms what is happening. What makes the current situation unusual is not simply that silver has been volatile. It is where demand is coming from and how it is behaving. China's sustained accumulation of silver has created a signal that does not fit neatly into common explanations. The signal is not found in commentary or forecasts. It is found in behavior. China's domestic silver price has been trading at a consistent premium to global benchmark prices. This is not a brief distortion. It has persisted long enough to matter. In physical commodity markets, a sustained premium sends a clear message. Buyers are not satisfied with exposure or future promises. They want metal, and they want it within their own system. Price alone is often misunderstood. A futures price reflects expectations, leverage, and sentiment. A physical premium reflects urgency. It reflects demand that must be met with delivery. When these two diverge, it suggests that the market's visible price is no longer telling the full truth. If silver were abundant and easily sourced, such premiums would not last. Supply would flow, arbitrage would close the gap, and prices would realign. The fact that this is not happening indicates tightness that is not easily resolved. It suggests a supply chain that is already under strain. Silver's importance goes beyond simple industrial use. It is a metal with a dual identity. It is essential for modern technology, energy systems, and manufacturing. At the same time, it carries deep monetary history. In China, silver functioned as money for centuries. That historical relationship with value does not disappear simply because financial systems evolve. When confidence in paper systems weakens, societies tend to gravitate back toward tangible assets. This tendency is not ideological, it is practical. Physical assets do not depend on promises. They do not require trust in counterparties. They simply exist. The timing of China's behavior adds weight to its significance. The global environment is fragile. Supply chains are stretched. Energy systems are under pressure. Debt levels are high, and purchasing power has been steadily eroded across many currencies. In such conditions, strategic accumulation of physical resources becomes a form of insurance. This type of accumulation does not require announcements. It does not need headlines. It happens quietly, through procurement decisions, and a willingness to tolerate higher prices. These actions are often dismissed by markets until their effects become unavoidable. Much of the mainstream commentary prefers simpler explanations. Volatility is blamed on speculation. Price swings are attributed to technical factors or fund positioning. These explanations are not always wrong, but they are incomplete. They focus on who is trading rather than who is taking delivery. That distinction matters. Speculators can exit quickly. Industrial users and strategic buyers cannot. When these participants enter a market, they behave differently. They buy weakness. They accept volatility. They prioritize access over short-term price efficiency. Their presence creates a foundation that charts alone cannot reveal. Silver is a relatively small market. It does not take dramatic shifts to change its balance. Persistent demand from large buyers can have outsized effects over time. Inventory drawdowns, delivery delays, and rising premiums often appear before prices adjust in a meaningful way. History shows that markets rarely reprice when everyone is watching closely. They reprice after signals are ignored, debated, and dismissed. By the time consensus forms, the adjustment has already begun. China's silver purchases are not a prediction. They are not a guarantee of a specific outcome. They are a signal. And in markets, signals tend to matter long before conclusions become obvious. To understand why the current silver story is different, one must move away from screens and charts and look at how the metal actually moves through the real world. Markets often appear efficient on paper, but physical markets obey different rules. They are slower, less flexible, and far less forgiving when supply tightens. Silver is not produced like most people assume. It is rarely mined on its own. Most silver enters the market as a byproduct of mining for other metals, such as copper, lead, and zinc. This means silver supply does not respond quickly to higher prices. Even if demand rises sharply, production cannot be increased easily or quickly. New mines take years to develop. Existing operations cannot simply turn a dial to produce more silver. This supply structure creates a fragile balance. When demand is stable, the system works. But when demand becomes persistent and urgent, pressure builds quietly. This pressure does not always show up first in headline prices. It appears in more subtle places: delivery delays, shrinking inventories, rising lease rates, and regional premiums. Industrial demand plays a critical role here. Silver is used in electronics, power systems, data infrastructure, and energy technologies. These industries do not buy silver because they believe a price chart looks attractive. They buy because production lines depend on it. If they cannot secure supply, operations slow or stop. That creates a different kind of buyer, one that is less sensitive to short-term price swings. This is why analysts pay close attention to how silver behaves during pullbacks. In a purely speculative market, prices rise quickly and collapse just as fast when sentiment turns. Buyers disappear and selling accelerates. But in markets driven by physical need, something else happens. Prices may fall sharply, but demand appears underneath. Buyers step in not because they expect quick profits, but because they see an opportunity to secure supply. Recent behavior in the silver market reflects this pattern. Sharp drops have been followed by fast stabilization. Each decline has attracted buyers sooner than expected. This does not mean the market cannot correct further. It means the underlying demand has not vanished. That distinction is important. Paper markets often struggle to capture this reality. Futures contracts, options, and exchange-traded products allow large volumes of silver exposure to be traded without a single ounce changing hands. These tools are useful, but they can distort perception. They create the illusion of abundant supply because positions can be created with leverage rather than metal. Physical markets expose the limits of that illusion. When too many claims exist relative to deliverable inventory, stress builds. It does not explode immediately, it accumulates. Participants may ignore it for months or even years. But when demand for delivery increases, the system becomes fragile. One of the clearest signs of stress is the price of immediacy. When buyers are willing to pay more to receive silver now rather than later, the market is signaling scarcity. Lease rates, short-term premiums, and delivery timelines begin to matter more than spot prices. These indicators are harder to manipulate because they involve real metal and real logistics. China's domestic premium fits into this framework. It suggests that local buyers are not satisfied with paper exposure or future delivery. They want silver inside their system. That preference changes global flows. Metal moves toward where it is valued most urgently. Other regions feel the effects later, often after inventories have already thinned. Another misunderstood factor is substitution. Some argue that if silver prices rise too much, industries will simply replace it with alternatives. In theory, this is true. In practice, substitution takes time. Engineering changes are slow, supply contracts are fixed, performance trade-offs are real. During this adjustment period, demand remains stubborn even as prices rise. This creates a window where the market must ration supply through price. Rationing does not happen smoothly. It happens through volatility, frustration, and sudden moves that feel disconnected from logic. Observers who expect calm, orderly adjustment are often surprised. The silver market's small size amplifies these effects. Compared to global equity or bond markets, silver is tiny. Modest shifts in physical demand can have outsized consequences. When large players act with patience and persistence, the impact accumulates quietly until it becomes visible all at once. For decision makers, the lesson is not to chase price moves. It is to understand structure. When physical demand grows in a market with limited supply flexibility, paper explanations lose power. Narratives about speculation, sentiment, or technical levels become less reliable. Markets driven by physical necessity do not announce turning points clearly. They grind, shake out weak participants, and reward those who focus on fundamentals rather than noise. Silver is increasingly showing signs of such a transition. This does not guarantee immediate repricing. It does not eliminate risk, but it changes the odds. When real metal matters more than paper claims, the rules of the game begin to shift, and those shifts often become clear only after they can no longer be ignored. When discussions turn to China and silver, a familiar idea often surfaces. Some suggest that China is preparing to back its currency with metal, creating a dramatic challenge to the global financial system. This idea spreads quickly because it is simple, emotional, and easy to imagine. But serious economic analysis requires discipline. It demands separation between what sounds powerful and what is actually practical. A currency backed directly by a metal is not a slogan. It is a system. It requires clear rules, public trust, and a willingness by authorities to give up control over money creation. Governments rarely choose this path because it limits their ability to respond to crises. It prevents easy stimulus. It restricts debt expansion. For most modern states, those constraints are politically and economically costly. Because of this, focusing only on the idea of a silver-backed yuan misses the more important point. Strategy does not always arrive through announcements. It often arrives through behavior. And behavior is what analysts must study. China operates within a global system that is still centered on the US dollar. That system offers efficiency and scale, but it also carries risks. Settlement rails, payment networks, and reserve assets are all subject to political influence. For a major economy, dependence on a single system creates vulnerability. Reducing that vulnerability does not require replacing the dollar. It requires options. Strategic optionality is not about overthrowing the existing order overnight. It is about building resilience quietly. This can involve diversifying reserves, developing alternative settlement mechanisms, and holding assets that are not someone else's liability. Metals, by their nature, fit this role. They do not depend on an issuer's promise. They exist outside financial systems. Silver occupies a special place in this context. Unlike gold, it is deeply embedded in industrial supply chains. This makes its accumulation less visible and less controversial. It can be justified as industrial planning while still serving strategic purposes. This dual role provides flexibility. It allows a country to strengthen its position without drawing attention. From a currency perspective, perception matters as much as mechanics. Confidence in a currency is shaped not only by policy statements, but by what stands behind the system during stress. Stockpiles of strategic resources contribute to that perception. They signal preparation, they suggest continuity, they reduce reliance on external supply at critical moments. This does not mean silver is being prepared for formal convertibility. It means it can support confidence indirectly. It can be used in bilateral trade. It can support domestic industries during shortages. It can act as a buffer in times of disruption. These functions do not require public declarations. They operate quietly in the background. The global monetary environment makes this behavior more relevant. Debt levels across major economies are high. Monetary policy has been used aggressively. Purchasing power has eroded in many currencies. In such conditions, holding assets that retain value outside financial systems becomes attractive, not just for individuals, but for states. The US dollar remains dominant, but dominance does not equal permanence. Systems evolve at the margins first. Small shifts in trade settlement, reserve composition, and asset preference accumulate over time. These shifts rarely make headlines until their effects become undeniable. Silver's role in this process is often underestimated because it is seen as secondary to gold. But silver's smaller market and tighter inventories can make it more sensitive to changes in behavior. When strategic demand intersects with industrial necessity, the market response can be faster and more disruptive than expected. This is why China AS actions should be viewed through a strategic lens rather than a sensational one. The absence of loud declarations does not imply the absence of intent. In fact, restraint often signals seriousness. Strategic actors rarely advertise their preparations. For observers in business and finance, the key is to move beyond binary thinking. The question is not whether the yuan will suddenly be backed by silver. The question is whether the architecture of global trade and reserves is slowly adjusting to reduce single-point dependencies. If that adjustment is underway, metals matter, not as slogans, but as tools. And when tools are accumulated quietly and persistently, markets tend to notice only after the balance has already shifted. In that sense, silver becomes less about speculation and more about infrastructure. It becomes part of how economic power is insulated against uncertainty. Those who understand this distinction are less likely to be distracted by headlines and more likely to recognize the significance of strategic silence. Markets rarely fail loudly at the beginning. They fail quietly through small fractures that most participants dismiss as noise. By the time prices react clearly, the underlying structure has often already changed. This is especially true in markets where paper claims and physical reality are allowed to drift too far apart. Under normal conditions, paper markets lead and physical markets follow. Futures prices set expectations. Physical buyers adjust gradually. Inventories move slowly. Arbitrage keeps everything roughly aligned. The system works only as long as trust holds and supply remains flexible. But stress changes the order. When physical demand becomes urgent and persistent, the paper market loses authority. Contracts can promise delivery, but they cannot create metal. When too many claims chase too little supply, the system becomes fragile. Fragility is not visible every day. It reveals itself suddenly. One of the first signs is inventory behavior. Not total inventory numbers, but deliverable inventory. Metal that can actually be moved to meet obligations. When this pool shrinks while paper claims continue to expand, pressure builds. Participants may ignore it because nothing breaks immediately. But the imbalance grows. At the same time, premiums begin to do the work that prices do not. Regions willing to pay more attract supply. Arbitrage channels pull metal toward urgency. Other markets feel tightness later, often after inventories have already been drained. This process does not require panic. It requires persistence. China's domestic silver premium fits this pattern. It acts like a magnet. It pulls metal quietly, shipment by shipment. Each movement seems small. Collectively, the effect is large. By the time other regions notice, availability has already changed. This is how physical markets lead. They do not announce regime changes, they enforce them. Paper prices often resist at first. Analysts debate. Commentators reassure. Volatility increases, but direction remains unclear. This period frustrates participants and shakes out those without patience. Then, repricing happens unevenly, not smoothly, not politely. Gaps appear. Liquidity thins. Price jumps feel disconnected from news. Observers say the move is irrational. In reality, the adjustment was delayed, not sudden. Another factor that accelerates this process is substitution delay. When prices rise, industries do not instantly reduce demand. Redesign takes time. Testing takes time. Capital investment takes time. During that delay, demand remains strong even as prices climb. The market must ration supply with price because it cannot ration it with substitution yet. This creates a dangerous misunderstanding. Some believe high prices will immediately destroy demand. In reality, demand often persists long enough to push prices far beyond what seems reasonable. By the time consumption adjusts, repricing has already occurred. Silver's market size amplifies this effect. Compared to major asset classes, silver is small. It does not take dramatic shifts to move it. It takes consistency. Strategic buyers do not rush. They accumulate steadily. That behavior is harder to detect, but more powerful over time. Another overlooked dynamic is psychology. The most aggressive moves rarely happen when excitement is high. They happen after volatility exhausts attention. When participants grow tired, when the market feels boring again, that is when structural demand often has the least resistance. This is why sharp pullbacks in tight markets can be misleading. They feel like failures, but they often serve to clear weak positions. If buyers return quickly, it signals that the underlying problem has not been solved. It has only been paused. For business leaders and decision makers, the implication is uncomfortable. Risk does not always arrive with warning labels. Systems under strain often appear stable until they are not. Those who wait for confirmation from headlines usually receive it too late. This does not mean every tight market ends in crisis. It means that when physical constraints meet strategic demand, adjustment tends to be discontinuous. Prices move in steps, not lines. Planning based on smooth transitions can fail. The silver market today shows many of these characteristics. Persistent premiums, resilient buying on weakness, slow supply response, strategic accumulation. None of these guarantee a specific outcome, but together they describe a system under pressure. The most dangerous assumption in markets is that tomorrow will look like yesterday. Structural changes invalidate that assumption quietly. By the time the chart confirms it, behavior has already shifted. In such environments, the question is not whether volatility will continue. It almost certainly will. The real question is whether participants recognize that the rules are changing before repricing makes that recognition unavoidable. When physical reality leads and paper follows, markets do not ask for permission to move. They simply do.